Hello everyone, I am Dr. Soundararaj. I am very happy to interact with you all through this video. In this video, I am going to discuss with you two exercises. One is related with the calculation of payback period and the other one is related with the calculation of net present value. These are all a couple of details related to my career. After you watch the full video, if you find the video useful to you, give a like to the video. Do subscribe my channel and enable the notification so that you will get the notifications of my future videos. Sum number 1 is related with the calculation of payback period. A company is proposing to expand its production, can go either for an automatic machine costing 2,24,000 with an estimated life of 5.5 years or an ordinary machine costing 60,000 having an estimated life of 8 years. So there are two choices available in front of a company. One is the automatic machine costing 2,24,000 which has got a life of 5.5 years. The other alternative is an ordinary machine. The cost of the same is 60,000 but have the life of 8 years. The details related to the two machines are presented down here. The annual sales and cost are estimated as follows. Sales that could be generated if you go for automatic machine 1,50,000 rupees. If you go for ordinary machine, the sales we can generate is the same 1,50,000. Cost. Materials 50,000 for automatic machine. Ordinary machine it has got 50,000 of materials. We need to employ labor to the value of 12,000 if we go for automatic machine. If we adopt ordinary machine, we have to spend 60,000 rupees for labor. Variable overhead in relation to automatic machine is 24,000. For ordinary machine, it is 20,000 rupees. Compute the comparative profitability under payback period method. So after we calculate the payback period, we should also find out the profitability of the machine after payback period. That means in the post payback period. Now you find columns are given for automatic machine separately and ordinary machine separately. Annual sales 1,50,000, 1,50,000 for both the machines. Less variable cost. Material 50,000 for automatic machine, 50,000 for ordinary machine. Labor 12,000 for automatic machine, 60,000 rupees for ordinary machine. Overheads 24,000 rupees for automatic machine. Again this 20,000 rupees for ordinary machine. The total variable cost for automatic machine comes to 86,000. For ordinary machine it comes to 1,30,000 rupees. From the sales, if you subtract the variable cost, you get the marginal profit. In marginal costing, this is what called as contribution. Now let us calculate the payback period. So this 64,000 and the 20,000 are the annual cash inflows for these two machines. Now let's calculate payback period. 2,24,000 rupees is the investment to be made on automatic machine divided by 64,000 annual cash inflow from automatic machine. So the payback period comes to 3.5 years. Similarly for ordinary machine, the investment 60,000 divided by annual average cash inflow from the machine is 20,000. So the payback period comes to 3 years. Using payback period, we can decide to go for ordinary machine because the payback period of ordinary machine is lesser than that of the automatic machine. Now let us calculate the post payback profitability. 64,000 rupees is the annual average cash inflow. The payback period is 3.5 years, but the lifetime of automatic machine is 5.5 years. So 5.5 years minus 3.5 years, the post payback period comes to 2 years. So 64,000 into 2 years, it gives us 1,28,000 rupees of post payback profit from automatic machine. Regarding ordinary machine, the annual average cash inflow is 20,000 rupees. Lifetime 8 years, payback period is 3 years. So 8 minus 3, the 5 will be the post payback period. So it's 1 lakh rupees. That's a post payback profit. Now let us look at the second problem. The Tamil Nadu Fertilizers Limited is considering a proposal for the investment of 5 lakh rupees on product development, which is expected to generate net cash inflows for 6 years as under. So they have given as the net cash inflows directly in the problem for the entire life of the investment proposal. It comes to 6 years. The investment to be made on the proposal is 5 lakh rupees. Now for first year, the cash inflow is 0. For second year, it is 100,000, so it comes to 1 lakh. For third year, it comes to 1,60,000. For fourth year, it is 2,40,000. For fifth year, it is 3 lakh. For sixth year, it is 6 lakh rupees of cash inflows from the investment proposal. The following are the present value factors at 15%. So they have considered the discounting rate of 15% in the problem. Now you are also given with the PVIF, present value interest factor values for all the 6 years, that's a lifetime of the project. If these are not given, you need to refer the PVIF table, refer the column of 15% and make a note of the PVIF values for the years from 1 to 6. It will come like this. If you go and refer this, you can take 3 decimals after the point. Now calculation of net present value. Here cash inflows, PVIF, present values. First year 0 into 0.87, 0. So here for second year 100,000 into 0.76, it gives us 76,000. Then for third year 160,000 into 0.66, it gives us 105.60 thousands. Then for fourth year 240,000 into 0.57 gives us 136.80 thousands. For fifth year, present value of cash inflows comes to 150,000. For sixth year, it comes to 258,000. The total of the present value of cash inflows comes to 726.40 thousands. From that figure, we subtract the investment made on the project, which comes to 500,000. That's nothing but 5 lakh. So the net present value is 226.40 thousand. So this is what about the net present value of this proposal. Since it is positive, we will very well recommend the proposal to the company. Thanks for watching this video. I hope I have done my lecture up to your level of understanding. I'll meet you in another video. Bye for now, everyone.